Good morning, friends. Welcome to the special subscriber webinar. This is a special arranged webinar. Unlike most of the times when we have been organizing subscriber webinar on Friday, we are organizing for the first time on Saturday. I know some of you have complaints because of the fact that we have changed the schedule. I would just like to restate that it is just because of the nature of this webinar rather than a permanent change. We would revert back to our normal course of conducting webinars on Friday evenings. The reason we are conducting the webinar today is so that we can make you ready for what may happen over the next few months post the election. Now that we have the election result, we are also seeing that the much of the volatility that was in the market. If I can just show you in a quick way to how the volatility was over the last few months and how it has corrected very significantly yesterday. Indian VIX or the volatility index, Indian volatility index, if as you can see, yesterday dropped substantially as one of the big uncertainties of the equity markets about how the political scenario will play out has simply not there now. No more uncertainty or risk is there over there. There's much more clarity over there. Personally believe that we should see this VIX continue to fall over the next course of next few days, and it should come down to somewhat close to say 14 15 levels, nearly similar levels as it was at the start of March. As you may remember, would have whipped up the election frenzy at that time, and there was a lot of uncertainty whether some people were expecting a hung parliament. Some few souls were also expecting probability of a UPA 3 in a much more weaker form coming back, and very few were expecting a BJP led coalition, but still a coalition government as such. I don't think most of us expected that a BJP-led government may come in, wherein the BJP on its own would have more than 272 seats. Now, to quick recap as to what has happened, and over this course of my webinar, I will also discuss some of the political challenges that may be there within the Indian democracy and their impact as to how another economy or the stock may play out. Now, one of the big reasons, things that has happened is after nearly 30 years, and I think much of the what I may say you would have been listening over the last one day, but I would try and take a economic sense of most of this and observations that political analysts have been making. So the much of my political analysis would not be much different from what you have been hearing. So yes, it is true that after 1984, this is one of the first time we are getting a government that can form a government on its own, because a single party has got more than 272 as its member of parliament in the parliament. And it is true that for the first time BJP has nearly tried to hit close to say 38% to 40% of vote share, which is very significant for a party like BJP. Secondly, it is also true that we may are seeing a shift in the dynamics of the political play that is in India. We may be seeing that a much more larger role may be played by BJP. The same going forward, same way the Congress has played a major role over the last 60 years or so. Now, what are the economic implication of this? I personally think of these two parties in a way of a simple framework. It's not a very definite framework, but it just helps me understand how the economic policies will go away, take place going forward. Now, when I think of Congress, largely I think of them as a center-left liberal party that is typically dominant in the Western European world. Now, this kind of a party typically tends to go after more entitlements, more right-based, more in a welfare-based in a economic structure, in building more of this kind of a economic structure. Now, given the way the Indian political discourse has been, there is no true right party as such, economically speaking. The closest that comes is BJP. And for quite a long time, BJP has been even be considered to be a party of traders. So it's not surprising that it shares a more center-right orientation. By center right orientation means that it would still have some amount of welfareism in it, because at the end of the day, both Congress and BJP are also moving towards more center and based politics, but within that it has a more a shade of right than left, and because of that you would see even the welfare based programs often this kind of a government would also have a sort of a more uh, market based phenomenon, in the sense what I mean to say is that let's take for example Narega, and even Narendra Modi has been speaking along that lines that Narega just instead of being a dole may be in a structure towards creating assets in the village level, like let's say check dams or other water harvesting projects, or let's say and even supporting agriculture during the harvesting time. So something of that kind is, as in it will not be just simply be a dole, but it would be much more be in a link to build up of some asset in the rural, or if the Narega is expanded into urban India, than in the urban India also. Now, this is how tend to structure these two parties, and much of the other parties tend to fall in one place or the other. So you may have people like Trinamool and say left parties at much more further away, but on the left-hand side of the political discourse. While on the other hand, smaller parties now that they are emerging, like Lok Shakti Party in say Andhra Pradesh, they are more on the right side of the political discourse. Now, the important things that we need to remember going forward is that we should be expecting a much more investment-led and criteria, investment-led economic kind of growth to happen. We should expect more of we should expect less of entitlement based and a system to take place, but more of an asset creation based system to take place. Second, we should expect more job creation to have kind of policies to take place, rather than social support kind of policies to take place. Now, over the last 10 years, one of the hallmark of UPA government was that it was more social security based policies that were taking place. We should expect more job creation, asset creation, investment led and economy to go ahead henceforth. Now, having said that, one of the key things I believe that an investor should consider now is that when you look at the markets now, markets, if I look at Nifty is close to 7,200, and that is a bit above our Sensex at MRP, and our quantitative analysis has generally shown that whenever we see either Sensex at MRP or Nifty at MRP being breached by Sensex or Nifty respectively, then we have generally seen that over and about 2.5% margin, the correction have generally taken place. Now, one of the key things to understand both MRP and this over here is that uh, one of the big uncertainties with respect to say political uncertainty has been removed. Now, the key question to look for is over the next 6 months, would we see, say, increase in corporate activity with respect to investment, with respect to new asset creation that may take place? So, there was a report by CMI which said that nearly $100 billion worth of project got shelved over the last 1 year. The key thing to look forward is, would some of these projects start coming back online? Would they finna start becoming active and live for the companies to really consider? Would there be more optimism within the job market? Would there be more optimism within the companies in investment? If those kind of things play out and they result in say a bit increase in the revenue growth rate or bit increase in the profit margins of the company, then even the Sensex and MRP would start moving up and drastically. So that is one key factor that one needs to be clearly understood. So over next 6 months, we may see that even in spite of our quantitative analysis with respect to how Sensex and MRP may be, both MRP as well as Sensex may be in a juggling around each other. We may see a correction, but that is a probability, not a necessity. I'll explain you why a correction can happen and why we should also look out for it. Now, one of the key things to understand is that out of the multitude of risk that the stock market sees, only one of those risks has now got away. Yes, it has been removed and it has now become like an opportunity rather than a risk, but only one of the risk has gone. That is a political uncertainty. We should not be expecting, say, a political paralysis, sorry, policy paralysis going forward. We should see more active and engagement of government along again with the economy. The As one of the commentators said that with Dr. Raghuram Rajan at Reserve Bank of India, with Modi's team at the central government, India may have one of the best dream teams as far as economy is concerned. And I, to some extent, support that if the government can work constructively with RBI, we should be seeing that by somewhat close to March 2015, if not March 2015, but by close to August 2015, we should finally be seeing inflation moderating to 4% or 5% kind of a thing, from nearly double digit and 8% plus kind of a inflation that we have been seeing for over last 5 years. That kind of a thing may still happen. Now, what are the key risks that are there still there in the market that most of the market participants are not realizing? One is there we are still running a risk that the monsoons might not be very good. Uh, the meteorological department is already on record of saying that there's 40% probability of a below average monsoon. Now 40% is a very high probability. Uh, so if we see a below average monsoon, we may see a very high level of food inflation, which would give very little room space for RBI to cut interest rates, and that might not necessarily work in the way the Modi government the Modi team has been saying that they want to actively pursue a investment-led strategy. Now, having said that, there are few things one need to understand. Uh, I think one of you in the questions that you have given us, he had asked clearly that how would the investment led boom happen, how would it impact banking. I think the cause and effect is a bit opposite. The banking reforms have to happen first before we can see a investment led boom taking place, and the key reason for this is that in India, IPO based funding of company expansion plan has been very rare. It has happened only on the few years come over the last 20 years. So yes, a huge IPO led and investment and IPO way of raising capital has happened in say close to 95 in 95 96, but then you had Asian financial crisis, so that again was not happening. Then again because of an in IT boom, you had it again in between of 2001 to 2002, so another 2 years, and then again once we had a correction, the IPO based market was nearly evaporated. Then again, we had it again in 2006 to 2007, which lasted till the early 2008, as in the January 2008, with Reliance and a Power IPO being the last, and nearly the MRMGF IPO nearly getting cancelled. So, point that I'm trying to make is that in India, capital-based investment strategy is generally pursued through much more through or capital raising happening at the debt market level, in which banks are the major participants. Now, if that is the case, we should not forget the fact that even today the bank balance sheets of PSUs banks continue to remain under high stress. Even in private sector banks, we have seen that even with the very well managed banks, there have been increase in the level of their gross NPA levels, which is not a very healthy sign. Uh, Now, having said this, what this would mean is that banks would be very reluctant to pursue aggressive investment strategy, which would mean that very few amount of capital will be available for private developers, private parties, so that they can build assets, and that would mean that large scale asset creation cannot happen. It is imperative, that's why, for the new government to see how to elevate the concerns of the bank. So two reforms that I would look for is, or two actions that I would look for is, how does the next government plans the capital raising activity for PSU banks, whether it would be a cost that would be borne by the taxpayers, that in the finance ministry, and pumping in cash into the banks, which we had seen for some smaller banks like let's say Canara Bank raising, I think, for about close to 500 crores over the last in the December quarter. But would that be the framework on the basis of which the government would like to move forward, or as some policy makers from the BJP have been suggesting that they may go for a slow dilution of a government stake through FPO market, so that the Indian investors can participate in the growth structure, and at the same time growth opportunity, and at the same time the banks can comfortably raise another required regulatory capital that is needed by them. Now, that would be the first action that would be the needed, because without that it would be very hard to think that a power plant can get financed, and a road can get a good and infra capital support from the banks. I think that would be less likely. Now banks reforms would be the first reform that I would like to look forward to. The second reforms would be and definitely be at the power sector, because if we are expecting a growth rate of close to say uh, 5% plus, and closer to, let's say, within by end of let's say over next 3 to 4 years, moving towards 8% at a sustainable level or better, then we need to see that and basic constraints that is in the power and infrastructure sector gets addressed. I think one of the good things of the Gujarat model is that there exists a good framework with which to go for the infrastructure based expansion plan. But however, even within the case of Gujarat, there still remains to be seen a good framework for power companies through which they can kind of build power assets, and through which India can move from say energy deficient stage to at least being at par with the demand and supply scenario with respect to power. Uh, One of the few things what that has happened over the last 15 years is that the composition of economy, if you see, a large part of the economy has been serviced, is been captured by the service economy, close to say 55 to 60%, and small parts by agri and manufacturing. So the out of the three triads, only one leg has become very strong, but other two have been weakened. We believe that going forward over the next uh, uh, 12 months, the government needs to pursue reforms that would lead to a more manufacturing-led growth and more agriculture productivity, to more agriculture productivity. Uh, and we believe these are what are creating the new opportunities within the investment market. Now some of them may actually already be have been factored into, but quite a many of others have not yet been factored into by the markets. And we generally believe that what has been factored into it till now is just a first level of thinking. So for example, if you would have seen yesterday, you would have seen that one of the big sectors that have moved very uh, positively have been banks. So the banks part, I think, is generally been factored into, probably at some level, especially in the private sector level, it has been factored too positive. Too much of positivity may have been factored into without considering the underlying risks and the underlying difficulties of executing that strategies. So some of the banks like SBI, Bank of Baroda, they're I think already above our comfort zone, and we would be a bit of a negative, but more like a fair value kind of a thing. We would not see too much of opportunities over here, but they would not be so ready to even recommend an outright selling of banks as such. Now, this is because of the fact that while these companies may have reached a fair value, we would like to see over the next 6 months whether we can see their balance sheets becoming much more stronger. That would give another flip to the valuations, both at the MRP level as well as the stock price level. So we would not like to lose out on that opportunity. Uh, the next quick thing is, yes, there is a good likelihood of chance of expecting a bull market to start now. But one of the key things to remember is that global risk continues to be at a heightened level. We are some of the good research houses, or the global research houses who track closely macroeconomic developments, they are a bit negative. They expect in a US economy may end may grow at only negative 0.3% to negative 0.6% in the second half of this current year, and that is not a good news. Second, while the risk level in Europe is now coming down, we are also seeing that the unemployment levels continue to remain very sticky, and that is not a very good thing, because then it simply means that the GDP growth that we are seeing may be just be a mirage. It may be just be fictitious, will driven more by the actions of the central bank, that is European Central Bank, rather than any positive happening at the ground level. Third thing is that in the China, while I personally believe that given the level at which the Chinese economy has reached now, it is not affordable for the world to have China grow at a 7% level. That would put too much of pressures on natural resources of the world. It would push too much of question mark on sustainability of growth rate of other developing economies, and that would not be good. But however, on the short term level, if I were to say, a slowdown in China will have an impact on many industries, and because of that one needs to be careful of becoming too much of gung ho of investing into companies that earn a huge amount of revenues that are dependent on how Chinese economy does. And it's not just an say natural resource companies like say iron ore or other metals companies like steel and such. There are other companies like auto. If you look at Tata Motors, a huge amount of revenue for them do come from another revenue that JLR generates through its business in China. Now, generally, what we have seen is contrary to what has happened historically, uh, the revenue profile of the companies who are more in a luxury kind of a business have not yet got hit as over the last 5 years. Even the revenue profile of global uh, consumer oriented businesses have generally got hit, but the luxury oriented goods have not hit. Now there is generally lag between how much a luxury based business like in a luxury watch, luxury cars get hit, and how much and how quickly a consumer goods get hit. But even with respect to that, 5 years and a lag is a big lag. So we would like to see if a continued slowdown in China, which has been driving the luxury and a market, would impact or not. A slowdown in China would definitely, if it we do not expect it, but if say it falls down drastically to 3%, 4% within next one and a half year, then that would be a big change in the global economy. We expect China to at least moderate to 5% levels of GDP growth rate, and then come down to a lower growth rate over the next as this decade comes to an end. Now, with that, I would like to take your questions. Uh, Now, the first question is by Mr. Rajiv. His question is, how can we take advantage of periodic price fluctuations of a stock many times during the long journey from DP to MRP? Uh, Rajiv, one of the key things you need to remember is that when I would say it from my personal experience rather than how it is, I generally think that most of us at some point of time would have thought this way or the other. It's very easy to think that if you could have captured all the curves that the stock goes from the top to bottom and then again from bottom to top, you could have sold it at top, got more at bottom, then again have sold it at top and got more at bottom, then you could have minted a huge amount of money. While on in theory it is right, the problem that happens is it's very hard to predict when the bottom has happened and when the top has been made. Sometimes it may happen that you may actually have got it at bottom and actually have sold it at top, but one must look at this as a much more as a luck based strategy rather than as a something that can be repeated very frequently. Now one of the key myths that have to be broken within the minds of the retail investor is that your aim is not to get a 85% growth in your portfolio, or your aim is not to get a big multi-bagger in your portfolio. Your aim is to get any strategy that gives you returns, but it can deliver you returns at a consistent level. So even a strategy that gives you a consistent returns, but even if it is, let's say, just gives you 13% or 14 percentage returns, that is much more important than a strategy that once in a while gives you a big multi-bagger. Because you think this way, I did some analysis or this we did some research, and we saw that nearly bulk of the Indian retail investors savings, like nearly close to 45% of his savings goes to fixed deposit. Now we know for our last 15 to 20 years fixed deposit have never beaten inflation, yet Indians feel so safe investing into fixed deposit, and safety concerns override any concerns of returns, that they have consistently tended to invest into fixed deposit, while only 2 to 3 percentage of their total savings tend to go into equity markets. So the key thing to differentiate yourself with respect to others would be, if you can see or a strategy that can help you get 12.5, 13%, but on a consistent basis, then that strategy would outperform even those strategies that can give you multi-baggers, for a simple reason that that would give you more confidence to put more much bigger capital at a much more higher generating rate than what you would have got through multi-baggers. Personally, I'm not very much comfortable with multi-bagger kind of strategy also, given the fact that when we are looking out for multi-baggers, we are going to underappreciate risk. Second part is, as you are saying with respect to curves, sometimes there are reasons that can come up because of the certain fundamental news driven actions that are taking place. So to take a very simple example, Hindustan Zinc, if I were to take, uh, and if you were to look at its price chart, you would see that there would be some sort of a curve over there. Let me have a look, and I will try and explain each of this curve, and with that I will try and explain and when this strategy can happen and when this strategy cannot. So let me take a somewhat of a max curve. Now this does looks like that, and we one could have easily got each of these falls and bottom. Now it was possible in Hindustan Zinc because much of this rise as well as the fall was definitely news driven. So around the time that when it was say close to 114, very few people were expecting that the government will become very active again toward this investment, and this rise has again been because of that fact that there was lots of news coming in which said that the finance ministry was actively considering movement towards disinvesting in Hindustan Zinc. And then as the elections approached, then expectations had again died down, it again went down. So the point that I'm trying to make over here is, if there are news based things that are taking place which are of a fundamental driven, then yes, you can play around on the DP to MRP mid kind of a scenario also. uh, However, it is not something that can be easy to do every time consistently, it, again and again. So there cannot, I don't think a system kind of a situation can be made which would help you get that kind of an DP to MRP story in which a stock moves to above DP but it has not yet touched MRP and it sees a bottom. So you can sell it at that in a top, short top, and again when it reaches its DP again we can buy it. So that is will be very hard to do on a systemic level, and because we cannot do it on systemic level, it would be very hard to say that it can be done on a consistency level to generate a decent level of return. So that is one reason which I would say you need to look into, so that so as to avoid falling into trap of a simplicity of the model. The next question is by Mr. Karthik. His question is, the markets have run up so swiftly, so should we sell a part of our portfolio to realize the gain? Example, what to do with BHL? Uh, Karthik, one key question that you need to answer is, I'll tell you how to think about sell. Sell actually is a much more harder decision than buy decision. When you want to do a sell decision, you need to think at a multiple parameters. If you have a very good company bought at a very good price, you should not be worried about a 10% 5% fluctuation that may happen. So for example, if you hypothetically saying, if you have bought into BHL at, let's say, somewhere close to 150 160 rupees price levels, and now it is close to 250. Now there is a, let's say, a good probability chance that it may fall down to, let's say, 5% 10% in a correction. So it may come down to, say, from 250 it may come down to 225. So we are seeing about a 10% correction. So should you sell, should you have sold BHEL? Now it's not a very easy question to answer, because what would you do with selling BHL? It makes sense to sell BHL only if you are seeing a much bigger opportunity in some other stock. So you can move that, or some other investment asset. So you can move that money that you have got from selling BHL and put it into say some big opportunity you are seeing in real estate, or some big opportunity you are seeing in, say, commodities, or some good new stock you are seeing. So you have, let's say, sold BHL and you have put money into say EIL, or say Punjab National Bank, or even in Reliance, then it makes a good sense. You are saying that you are going to move from investment from BHL to some other asset class. The second case would be when you think that the BHL has now clearly become overvalued. Too overvalued, market is too expecting too big an optimistic a scenario that is unlikely to happen. Now, in that kind of a case, the case that as of now think is very true for some companies like Reliance, L&T, to some extent to HDFC, where the market is expecting too much of optimistic scenario to play out rather than a realistic scenario to play out. Yes, it may make to sense sit on cash, because a correction, if it happens when it happens, can be too big a correction. As in it, we can see a 20%, 25%, or even 30% correction if such kind of an overvaluation has happened. Or we may see the company might not correct, but it might not even move much. It might tend to stay at that level for quite a long time, so that over while correction might not happen, we would lose it because of the inflation. There our real returns would be very low. Now, because of this reason, I would say that do not go for that 5%, 10% correction levels. If you have a good company, stick with your good companies, because if the bull market is just starting, if the economy is just trying to go up, then what was going to happen is that we would for saving just saving 25 rupees on BHL, we would lose out a big BHL move that may happen because of the betterment of the economy. And when by the time BHL reaches 600 or 700, we would be thinking that yeah, I should not have sold BHL for 25. It's too easy to say that yes, I can do that. If you can consciously do that, go ahead, go great. It's a good way of getting more shares for every correction. But I personally think that the only person who makes money in this kind of a flip kind of a strategy is broker, because it makes us to trade at a much more regular frequency. If I have good companies, I would rather like to stick with them. Even if they see a 5%, 10% correction, I would not be too much worried of it if it is not hitting my capital as such, my invested capital as such. The second thing is, should you be entering now? I would be a bit cautious about entering now, as I said right at the start of my presentation, that the very fact that market is looking at just one positive, that is a political and a scenario becoming too clear, political scenario giving us a real hope of a change happening, is underestimating other risk in the markets. So, for example, over last 5 to 6 years, inflation has been very sticky. Many of the problems of the reform like land and environmental are something that wherein we need broad consensus. Just because BJP has a huge number of seats does not mean that it can proactively address them within next and a few months and change everything. That is not going to happen in spite of the very large number of seats with the current government, the expected new government. And because of this reason, I think that people are underestimating the problems of India. People are thinking that problems of India can be solved over the next 7 to 8 months. I don't think that can happen. We may definitely we can hope to see a move towards that, but we should not build ourselves to thinking that that is definitely going to happen. And because of that reason, I would be a bit circumspect of investing in an equity market at 7,200 level to 7,500 levels. Even at a risk of say the markets going towards 8,000, I would rather stay away. I would like to see either one of these risks to start plummeting down, or markets to correct and accept that these risks are there in the market, and the market to come down to somewhat closer to 6,200, 6,500 levels, wherein I think many of the cyclicals that have also run up on the hope would also come down, and then that would be a great time to enter into the markets. The next question is by Mr. Manik Surveyor. His question: with new government, which sector will benefit? Any scripts that can be suggested for buy or sell, if any? Dear sir, key sectors that would do extremely well would be all sectors that have a cyclical nature. These are companies that have not performed well over the last 5 years. For example, you would see infrastructure do well, even though we do not recommend infrastructure because of the fact that they have very highly leveraged balance sheets, and most of them do not have a very good cash flow model. However, some like Ashok Buildcon, IRB infrastructure, without considering other aspects, just looking at the kind of business model that they have developed, IRB infrastructure, these are the companies that would do extremely well. So infrastructure sector would not do extremely well. I generally tend to like companies who tend to provide services to infrastructure, because they tend to have much more better cash flow models than the infrastructure companies. They tend to have very low leverage than infrastructure companies. So I think cement would do well. Steel can also extremely do well. Another set of companies, though they are cyclicals, but more than cyclicality of their business model, what we tend to like is that we expect a good level of reform to take place within the natural resource sector. So companies who have very strong balance sheet, who have very strong business operational and a model, so and who are in the natural resource space like Kane India, Sesa Sterlite, NMDC, MOIL. These are the companies that we believe would be extremely beneficial over the longer term for the companies. Uh, just a request, could you just let us know if you can hear our audio? You can let us know through the chat window. I would just like to have a check at a local level. At our level, we are checking, we are getting the audio. Please let us know whether. Thank you very much, Mr. Parag and Mr. Suman, for letting us know. Uh, Now, given this fact, natural resource based companies who have very strong balance sheets, capability to invest into a new natural resource projects like, as I said, NMDC or Moil or Sesa Starlight or Kane India, those will the definitely be other companies that we would like. Third, as I stated right at the start, PSU banks, especially those larger PSU banks and just one or two smaller PSU banks. So larger PSU banks, SBI, PNB, Bank of Baroda, Canara Bank, these would be the companies that would do really well, fantastically well, as far as their business goes. Out of that, I think SBI and BOB have already run up, but PNB, Canara have not. So we would be more be positive towards PNB and Bank of Baroda, sorry, by PNB and Canara Bank rather than SBI and Bank of Baroda. Not to say that SBI and Bank of Baroda are not good banks, just that those things have already been factored into. Second, on the smaller banks, we would tend to like more among the private banks. ING Vysya would be one of the few private banks that would tend to like very good asset, very good management, available at a decently fair value levels. Any expansion that may happen in the infrastructure level or at a trade level would definitely be beneficial for that ING. Even today, Indian Bank continues to be at a very attractive levels. But on the only risk being that now economy has to perform for Indian Bank also has to grow at a share price level and as well as a business level. So these would be the few banks that we would tend to like. The fourth would be definitely would be the power sector companies, but just like infrastructure companies, we believe that the power sector framework has to first get cleared. So instead of the power companies, we tend to like companies who provide services or goods to power sectors. So these would be BHELs, these would be Thermax, these would be even be to some extent, if the ownership part can get cleared, then even be Crompton Greaves. So these would be these kind of companies. Now, this is the broad companies that I think would do extremely well. I also expect that going forward over the next 24 months, interest rates should come down. So one can look at companies that have bit of a leverage, not something that is very threatening, but a bit of a leverage, and that leverage can give you an additional jump in returns. So some companies like Sale, even though yes, it is also part of the cyclical story, but if you can look into this kind of companies, they will also tend to do extremely well. So these are the broad framework that within which you should be focused on. I think compared to most other people, I generally don't expect a huge return happening in the IT sector. I On the one side, my expectation is not driven by the fact that rupee may appreciate to 40 levels. I am not expecting that kind of thing. I do believe that rupee may appreciate, but it will be just minor, somewhat close. It would just fluctuate in between 58 to 60. It may go for a short term to a higher level, but I think RBS can comfort level rise in between 58 to 60. So rupee would be there. The reason I am bit negative on IT is because I see globally heightened risk levels. Second, I see most Indian IT companies have not seen India itself as a big IT market. excuse me. Yeah. And second, on the fact that over the last 2 years, one of the big reasons because of which we have seen a phenomenal growth in the revenue as well as the profit level for IT companies has definitely been continuous depreciation of rupee. So that have aided their profit margins and profit levels over the last 2 years. But I think it would be very tough to keep on having that kind of rates going forward. One of the key things that you would, if you were following any of the IT companies, you would observe that the number of projects that the IT companies are getting at a $1 billion level or 500 million multi-year levels, those are now seemingly decreasing, and you are seeing much more higher level of projects coming in at 10 million to 50 million kind of a range, which indicates that at some level the customers themselves have realized that instead of going for a single vendor model, it makes more sense to have software architect kind of a person at your own your own in-house level, and then outsourcing and only key modules to companies like Infosys and Wipro or Cognizant for that matter, or Tech Mahindra or TCS. What this results in is that the margin in a small project tends to be much more lower than the margin that another company could have commanded at a higher price level, and as a result of that I don't think the IT would be very attractive space. Second definite space, but not because of the Modi, but because of the fact that now we are seeing increased R&D levels, increased research levels happening in the Indian pharma sector. So some of the good pharma companies can be definitely be a play. So Sun Pharma could definitely be continue to remain a play. Lupin may also continue to definitely remain in a play. Just expect for a few price corrections so that you can get it at attractive price, and then we can enter into it. So those would be the few sectors that I would look at. I think I've covered a huge broad range, but I think you should look for a selective opportunities in each one of them to build up a diversified portfolio. Uh, then similar question was asked by Mr. Nandkumar Pillai. This question was on stock investment in general. I believe over the how one should position one's portfolio over the next 2 to 3 years. I believe the previous question would have answered it for him also, for you also, sir. The next question is by Mr. Girish Vyas. His question is five safest stocks which can be brought now for next 3 to 5 years, which are reasonably valued to give the upward swing in next 5 years. Provided you do a yearly audit, I would say that the companies that you should go and look out for would be EIL, in the capital goods space. Uh, Coal India, this was one company that I missed out, and Coal India is not on the basis of the natural resource part. That is true over there, but I also expect that we should expect a reform in the coal sector, given the fact that most of the power plants that are getting built in and around India coal-based, and it would not be a prudent scenario to see wherein power plants which are coal-based are lying idle, or they're importing expensive coal from outside, uh, and especially in a case wherein the power plant was designed to handle only Indian coal and it has to use Indonesian or Australian coal, then that would mean that the life of the power plant also would not be quite high. Coal India would be the other one. EL would be the second one. Among the FMCG, if I can get it even, let's say, not at that high price, but at least a 28 P. Now I would like to have IT. I think ITC would do again extremely well. One can bet on, and if the job market does well, we can surely think that even the disposable income will do well, and that should support FMCG goods company also. In that, compared to HUL, ITC is at least pursuing a very good growth strategy, and we also expect that its FMCG business should now become very good and EPS accretive, so that should also support and a better valuation for ITC. So ITC would be the other, I think, third company that one can look for. If one can be a bit of a more risk taker, then one can look into some infrastructure companies, especially like Ashoka Buildcon or an IRB infrastructure kind of a company. Mind you, IRB infrastructure has a small amount of corporate governance issue with respect to the fact that there is a court case, a criminal court case running against its promoter. So one needs to be careful with respect to that. I believe some good real estate companies like Opera Realty, Prestige, uh, Shobha, Ashiana can do extremely well. We tend to really like Ashiana but it is a too small cap company, so it it generally does not falls into the purview of money works for me and a scope of companies. But Ashana is definitely a company that we would like. Uh, at the price of 100, I would be bit of a careful, but Ashana is one company that is very well run real estate company. So if you are okay with say 30% kind of downside, then even Ashana is a very good company to enter into. So these are the five companies, strong management, good companies who can do extremely well over the next next few years. The next question is by Mr. Parag Storwala. His question is, for the next 5 years, what will be the percentage in mid cap and large small mid cap, small cap, and large cap? Parag, this is a question that is too personal in nature. The key question that you need to answer first is, what is the level of risk that you can look at for? Now, in the small cap, there are lots of companies, but the business model and a risk tends to be very high in the small cap. The mid cap business model is less risky than small cap, but it is definitely much more higher than it is for large cap. Now, the personal part of the question is, the key question that you need to answer is, in a particular day, how much is the downside that you can see? So let's say you wake up one fine morning, are you comfortable seeing 30 percentage downside, 20, 50 percentage downside? Then you should restrict yourself only in the large cap and mid cap space. If you can see just 20% kind of a downside, even after having a good structured portfolio, then you should restrict yourself only with large cap. If you are willing to go full on, do a high level of qualitative research, and yet see a 50% level of downside. See, the difference between what I said first and the second is the level of research that you are personally willing to put into. Then you can be much more and a geared towards and a small cap as a larger part of your portfolio. But if you are just a normal real investor who cannot see more than 20% and down in his portfolio in a single day, then I think concentrating nearly 75 to 80 percentage in large cap, uh, another 10 to 15 percentage in mid cap, and just 5 percentage in small cap would be a very good strategy, so that even if the small cap does not works out, the impact on your portfolio is very minimum as such. So that would be what I would suggest to a very risk averse and a retail investor. But key question you need to ask is, what is the downside that you can look at? If you can give me the downside, then we can sit together and discuss about what should be the split you should be looking at individually. The next question is by Mr. Balachandra. His question is, will infrastructure will be the next big movers? See, sir, yes, it is the hope of most of the analysts across India that infrastructure on its own, infrastructure will be the next and growth story in Indian equity markets, driven both by an increasing order book, more projects, uh, uh, lower and leverage cost. So that way it may work out. The uh, the only reason that I have a personal negative bias with respect to infrastructure is, most of these companies tend to have very high leverage. The leverage in its own is not negative. The problem is that they tend to have very negative cash flow from operations. If you can find companies, infrastructure companies that have positive cash flow from operation over last 3 to 4 years, those are the infrastructure companies that you should go after. Now, like infrastructure company can go for a very high level of leverage. That leverage does not scare me. I'll tell you the reason that leverage does not scares me is, one, most of the infrastructure companies get a very low subsidized and debt from the government, close to 6%, 8% kind of levels. So going after a debt way of funding your infrastructure is really a good capital structure strategy. The problem occurs when you do not and earn sufficient cash flow from operations, then you enter into a negative spiral of increasing debt levels, and that does not nearly works out good for you. And that has been problem with say the GVK and GMRs of this world and Lanco of this world, that wherein they had raised debt levels, they had negative cash flow from operations, just book profits and not real cash flows. Because of that, we are seeing increased level of debt, and that's why they have continued to languish for a much most part of the last 2 to 3 years below their price to book value. And so I would tend to avoid this kind of companies. I will tend to like companies who have very strong cash flows. But if you can find it with the infrastructure story, you would have a decent level of safety, and yet a good promise that if the infrastructure story really plays out, it should move forward. Given the history of an BJP government that we have seen both at the NDA level as well as most of state level, infrastructure build up is one of the key aspects of most of the BJP governments, whether they are in MP, whether they are in Chhattisgarh, whether they are in Gujarat. One of the key aspects have been that uh, second, when you saw during the NDA level, look at the contrast in between the UPA and the NDA level. When the 2008 crisis hit, and most of the industry was asking for help, we got subsidies for the industry. So either the VAT was decreased, or the education cess was not decreased. So indirect tax support was given, or you had much more higher depreciation level for kind of companies buying cars, so that the auto industry could have got support. So this kind of support, or dole out support, subsidized support, was what was given. But in 2002, when we had another crisis happening, and the risk of an Indian economy slowing down, we had Atal Bihari Vajpayee coming up with an infrastructure story, that is the Golden Quadrilateral story, and that really gave a flip to the growth of the Indian economy, as the Golden Quadrilateral really started completing itself. Because of that reason, I also think that infrastructure would do much more better. It would be the go-to and a sector whenever and if India were to see any economic slowdown as such for the BJP. So that would be the one place I would be invested in. Just be careful, invest only in companies that are uh, positive cash flows. The next question is by Mr. Abhishek Deshmukh. His question is buy, hold or sell Titan, Kane, Colgate, ITC, Hindustan Zinc, Sesa Sterlite, PNB, Bank of Baroda, Indian Bank. So Titan, you can look out for selling over and above 300. I generally think that much of the positives have been really been factored into. But as I told you about Titan, do you really want to sell a very strong, good company just for a 5%, 10% correction? That is the key question to answer. If you are comfortable, you can go ahead with that kind of sale for Titan. Same is for Kane India. Kane India, I would still keep on holding. If I can get it close to 300, then I will add it, but not otherwise. Uh, the next Hindustan Zinc, I think over the next few months you should expect the Hindustan Zinc disinvestment to really take place. So Hindustan Zinc would be one company I would really continue to be invested in. If needed, I can still add on to it, but with an expectation that disinvestment, if it happens, should happen only at a price level of 160. So around the price level of 135 that it is there today, the upside is a marginal of 30 bucks. That should translate into about 20%, 22, 23 percentage or so. Bank of Baroda, one can think of selling and exiting, because there are good opportunities in other public sector banks, especially like Canara Bank or PNB. So I would be thinking of, I can think of, I would suggest of selling in a Bank of Baroda and entering into this. Indian Bank, n- not very comfortable risk reward scenario. I would continue to hold. Uh, if a small 5%, 10% correction comes, then I may really add Indian Bank. If you are comfortable with that kind of a downside of 10 percentage, then you can also add Indian Bank at the current price levels also. ITC, if you have ITC and it's at a good price, I don't think you should be selling ITC, for a simple reason. These are the kind of companies that you should be keeping for a longer term, unless they are losing out their way. So you should keep on holding ITC. If we see a slight correction happening, then and if it falls down to say 20p, as in the EPS grows up, but the market does not gives to it too much of a benefit, then we should go full hog on investing more in ITC. Indian Bank, as I said, I'll re-clarify, is continues to be a buy at our level. The only thing is that, as I said, the risk reward scenario is not very comfortable at this price. So uh, it's not a sure shot. If you are okay with a 10% kind of downside, then Indian Bank is gonna buy even at current levels. Uh, the next question is by Vidya Pandey. His question is, what is your view on TCS? Among all the IT players, I think TCS is one that we tend to like. But having said that, TCS also, just like most of the IT companies, is going to face a problem of commoditization of the bread and butter business, and on the other side of the fact that the consulting side of the business has yet to pick up, and the product side of the business has yet to pick up. So because of that, I would be bit reluctant on investing in TCS as of now. uh, uh, it needs to correct a bit, because before we become really excited about TCS. So for now, I would not be so much of an cautious. If you have TCS at a very excellent price level, and you are not seeing any other opportunity in market, keep on holding TCS, because it's a very good company. However, uh, if you are seeing opportunities, it may be a good time to move out of TCS to some other company. Any upside as such anyway would be just close to 2700 to 2800 level. That is just about 10, 15 to 20 percentage points. And over next 12 to 24 months, I think there are much better opportunities that can give you much more better returns than what TCS can give you. The next question is by Mr. Balasundaram Rangaswamy. His question is, should we wait for some nifty correction to buy stocks again? Definitely, sir. As I said, you need to look at two levels. One is a decrease in the level of risk that exists in the market with at other levels as a global risk as well as say the risk at the Indian macroeconomy. Uh, Either one that has to happen, and even if that happens along with the markets going up, then we can invest into it because the risk has come down. Or second, the markets have to correct to and recognize that this risk exists, and it has to come down to at least 6,200, 6,500 kind of levels, and then again we can invest into it. So look out for a small correction to happen. Remember, US is continue to go on tapering, and that is going to have an impact on the US economy. You need to see whether US economy will continue to remain strong or it will see a small correction. If small correction does happen and it moves to a recession, then it would result in a spillover effect happening across the global equities, and that would be the great time to invest into equity markets again. The next question is from Mr. Prashant Kadam. Is it time to shift from consumer to investment theme? How to play export theme, IT and pharma? I do think that it may be a good time to move out from consumer to investment theme. The only unfortunate part for this way of strategy is that none of the stocks are at any cheap valuation levels. So only investment themes where there are available at cheap valuation levels would be the place where I would like to move into. On how to play export theme, see the aspect of a rupee appreciating and that having an impact is too overplayed. We do not believe that a rupee should be moving to 555 or 50 levels. We think it would continue to remain at 58 to 60 levels. I have already explained our view about the IT and pharma. Pharma companies who have very good business model to capture the global export market. That would be the companies that we would really look out for. Besides that, small companies like FDC who have developed some niche product levels, these would be the other companies that we would look at. But otherwise, we would not be so much interested in other companies because of the run up that has already happened in the pharma space. Then next question is by Mr. Nimesh. His question is, what is outlook going forward as MRP is below current level? I presume you are asking with respect to Sensex at MRP and Nifty at MRP. As I've already stated, that generally what we have seen at a quantitative level is that 2.5% plus or minus is the range of Sensex or Nifty and around our MRP that we consider to be at fair valued. Anything above that, we generally see a level of correction. As I've already stated that there are lots of risks that are there within the equity markets, and unless those risks are accommodated at some level, as in those risks come down or the market tends to accept those risks, we would not be so interested in investing into equity markets, which means that the uh, current level of Sensex and Nifty either has to correct or our MRP has to go up. Our MRP will go up. It will be dependent on two factors and two factors alone. One is increasingly better corporate performance over the next 6 months. And second, decrease in a level of macro level risk that exist in the global and the Indian economy as of today. If, if these two factors play out, our MRP may increase rather than a Sensex correcting. So these are the two things that you need to keep in place, keep in your mind while understanding how you should play our MRP and the current levels. The next question is by Mr. Baswaraj Kalpur. His question is, as I stated right at the start, Mr. Kalpur, this is a exceptional time, exceptional reason because of which we are doing it on Saturday. We will not be generally be doing it Saturday. We'll be doing it on Friday around 4 p.m. only. But we wanted you to be updated with respect to how you should place yourself going forward, given the election results that have come in on Friday. And as you know, we were waiting for the final confirmation of election results. That's why we could not take it yesterday at 4 p.m. And we wanted to have a clear discussion within the our investment management team and understand how things would play out. That's why we could not have it yesterday. That's why we, as an exception, having it today. The next question is by Mr. Shreyas Sawant. His question is, will MoneyWorks for me also give targets in futures and options? As of now, no. As of now, we would like to focus on what is our core competency, that is in equity markets, and generating and sustainably and outperforming returns for our investors, the way we have been doing since the last this December 2013. Uh, we would like to continue to do that, continue to beat Sensex and Nifty by a long margin. So we would like to focus on that. Futures and options, unfortunately, in India, we do not have very long futures and options that can span over a year or more, wherein there is a good amount of liquidity. We have very short-term and oriented 3-month oriented futures and options, so it becomes very hard for a long-term oriented investment strategy to play out its strategy future option. So as of now, it is not within our scope of an analysis. And the next question is by Mr. Ashles DeCosta. His question is, what are the prospects of Larsen with money works for me? Uh, as recommended to sell in past 1 year. Yes, we have continued to recommend sell over the last past 1 year with Larsen, and the key reason, and which is very simple reason, is that the balance sheet of Larsen continues to be stretched. We do not see that balance sheet and becoming an underlevered anytime soon. We continue to see that there is a management which continues to reward itself and disproportionate to the value it is creating for its shareholder. We continue to see that another company is having negative cash flow for now 4 to 5 years now, consistently. And with respect to the level of negative cash flow, and with respect to the amount of and a disproportionate amount of money that the management has given to itself in terms of ESOPs as well as salaries, we are not very comfortable with this kind of a strategy, and that is why we are negative on L&T. Now, sometimes our strategy may work, sometimes our strategy might not work. The only thing that I am much would be much more worried about is to be caught on the wrong foot with respect to my buy strategy. There are people out in the market who tend to like L&T, and I would just beg to differ with them, and I would like to see how when a time sees L&T doing well. Much of the time, I think in India, unfortunately, we in India give too high importance for growth without understanding the importance of the capital efficiency. I do not like companies who give just 7%, 8% kind of capital efficiency ratios. So if you were to look at Larsen, my single question to the Larsen management is, if these are the kind of the return on capital employed ratios that they are producing over the last now say 6 years now, then why should not they just divest the whole of the company, liquidate the whole of the company, and so that the investors can invest their money in a fixed deposit and earn a much more better return on their capital. Now, if this is the kind of business model that the Larsen management is building, we do not like this kind of business model, and we would like to stay away from this. As I stated before also, this is except for the 2 years in 2009 and 2010 when it earned a measly and a small amount of cash flow from operations, one year 496, another at 2000 crores. If you see, since from March 2008, it has generally been earning a negative cash flow from operation. I would not be surprised that in the March 2014 results that it publishes, it would again be earning a negative cash flow from operations result. And that is the one reason because of which you do not like companies like L&T, in spite of them these companies been the darlings of the stock markets, which we believe that these are the darlings that one day would be recognized as early ducklings by the markets and would be valued as such. If available at a extremely low valuations, yes, L&T makes a sense. So if L&T is available at anywhere lesser than 360, we may look into it, because then we are just basically valuing it on a liquidation basis. But otherwise, a company that has a so pathetic return on capital employed, it should not be enjoying that kind of P's that it has been enjoying. I believe it is should be an underappreciated by market, especially in a management that is entering into each and every in the sectors that it does not have core competencies. I would like to really understand what engineers have competency in running an insurance company, what engineers have competency in running a bank. So this kind of left, right, and center diversification without looking for capital efficiency is not something that is very good for the shareholders. It just means that the management is more interested in creating an empire for itself rather than value for the shareholders. The next question is by Mr. Deepak Madhavan. His question is, which sectors are good and what's your take on Grasim and BHEL? I think Mr. Deepak, the first part of your question with respect to sectors has already been answered. Both Grasim and BHEL are extremely interesting stories. We tend to like both of them. Uh, we believe that as the infrastructure build-up and power build-up would take place, both Grasim and BHL would be extremely beneficial to that. Compared to Ultratech, we tend to like Grasim because of the valuation differences in between the Grasim and the Ultratech. That is one. And BHL, yeah, at 250, I would be a bit careful, but I do think that the prospects of BHL are only going to become better and better going forward. So one can take that kind of a risk with BHL. So on both Grasim and BHL, we are positive. Grasim already is close to 2,900 levels, so that would be one level thing that would be a constraint on us because if one needs at entering at 2,900 level, one needs to be open to a 10 to 15% of price correction. If you're open to that kind of price correction, I think Grasim is good buy even now. You can look for an fair value upside of about close to 3,400 to 3,700 levels. BHEL, if the power sector starts improving, more order book flow, I think our MRP is also going to go up henceforth. So I'll continue to stay invested in BHEL. The next question is by Mr. Mahfuz Khan. How quickly do you update financial information on site after it's available and what is the source? See, we update once the financial information, that is the annual report is available, then that gets updated on the next day of it. We use an Accord FinTech that is generally been used by most of the India-based equity markets, including larger brokers, as a source of getting it on the website. So we update it within a day with respect to your 10-year X-ray or so. The only one part, the value creation index part, it takes time because we need to have a sectoral level data of each of the companies, and then it is what it gets updated. So that is the one reason that there is a delay of up to 12 months with respect to value creation index. But it's okay. The thing that you need to see is, has the value creation index been consistent over the longer term? That is the way we need to see, rather than one single year of red, green, or orange. We need to see it over a longer term how things have been moving around. The next question is by Mr. Ankuria. His question is uh, s- stock sector to be looked at post election. I think Ankuria, our whole of this presentation has been on that, so I assume that would have been taken care by us. Similarly, next question is by Suman Kumar. Cyclical recovery under any government, the government part is now anyway clear, and I have already laid out what aspects we are looking out from this government that should help in cyclical recovery of the markets as well as certain cyclical stocks. Uh, the next question is by Mr. Armungam. His question is, please list five multi-bagger quality stocks to hold for last 10 years or more. Two things, we generally do not recommend multi-bagger stocks because we believe that in pursuit of multi-bagger stocks, what tends to largely happen is that we underestimate business model risk or management risk that exists within the companies, and as a result, we latch on to much more higher level of risk than is realized by us at the start of the investment thesis of ours. Second part is, as a company policy, we do not recommend multi-baggers because we believe that instead of getting a single year 85% return or 100% return, which even a monkey can get, much more important is and much more challenging is to get in a consistent returns, even if those are in the range of 12 and a half to 15 percentage. But getting it over consistently would be a much more bigger challenge, and that is why, as an investment strategy and a policy, we do not suggest any multi-baggers nor recommend investors to go after chasing such multi-bagger mirages. These do not do anything besides just boosting the ego of the falsely boosting the ego of the investor, because we would like investors to focus more on generating returns at a portfolio level rather than on a single stock level. Uh, the next question is by Mr. Shira Shah. His question is, you have reevaluated PMB, but BOB you have not reevaluated any reason. One of the reason why we have not reevaluated BOB is that we do not see much of a change happening in our expectation of BOB, and we are also analyzing the result of BOB. And once we have analyzed, we would see if there is a then it would you would see a new DP and MRP, but on a provisional basis, we do not see a major change happening at BOP level as such. The next question is by Venkatesh. Sorry, I cannot. Yeah, the next question is by Venkat Krishnan. His question is it a good strategy to periodically book profits? See, you should look at periodically booking profits when you know that this is a company that is not a long-term strategy company. This is a company that you have invested as a opportunistically. It is an average company. You have bought it at a extremely good price levels because of the fact that market was going really negative on them. So you can think of booking into this company. So if you have bought into say small PSU banks, following our strategy in the month of August and September, then you can really look at a booking and a profit at a regular intervals. But if you have bought into IT company like ITC, I don't, or say BHL or EL, I would not recommend booking profits. I think you should go full hog, especially if you have bought it at a good price levels. Booking your profit does not does any better. The legendary investor Peter Lynch said that booking profits and at regular intervals just leads to an uh, taking removing lilies from the garden and watering the weeds. So we should not follow that kind of a strategy. So I think if you have bought into an average company but on a continent based strategy, then one can look at for booking and profit at regular interest. But unless otherwise, if you are bought into a good company, don't look at booking profit at regular interest. Ride out whatever it is. Do not be worried about the 10-15 market correction that happens. The dividend that you would get over the longer term, the capital appreciation that would happen to you over longer term would pay off any such 10-15% price correction. Rather, any price correction you should be thinking of, should you be putting a much more higher level of capital now again. So the next question is by Mr. Vidyapati Pandey. The question is, sir, there is always a debate uh, of FD versus equity in which people like you advocate for equity. Sir, if 20% of FD comes to equity, what will be dividend yield for the investor? By investing in secondary market does not mean the money is for companies. Uh, Good question. I would kind of take this in parts. One is yes, we generally tend to advocate more in equity. One of the reason is because Indian household invest a very low amount in equity. We generally do not expect that on an average every household is going to increase its equity level from say 3 percentage to total 20 percentage. But people who are getting who are actively seeking out research services or who are willing to do research on their own, they should over a period tend to invest more amount of level in equity, because otherwise with respect to the amount of time you are spending or amount of money you are spending and the small portfolio that is of yours that is there within the equity market, the return and cost and benefit in a scenario does not necessarily sit in a structure. So if you are taking research service, or if you are taking research, if you are doing your own research, if you are invested with a much more larger portfolio, then even the returns would be much more better for you. So that is the reason I would like you to think of investing more money if you see a consistent level of returns. The key question is, if you see consistent level of returns, start increasing your portfolio size in the equity market from FD level. But if you are seeing a research either on your own or through the service provider that is not giving you consistent return, I think it is better to stay with FDs rather than with equities. The second is with respect to dividend yield. I don't think there is a good correlation with respect to how much you are investing or how much average Indian invests and with respect to how much dividend yield would be on. The dividend yield is a much more a function of when the investment has been made, at what price levels the companies have been bought. If things happen like let's say tomorrow, for some hypothetical reason, markets go back to go to some crazy levels of 40,000 or 60,000 as some people within the financial markets are expecting, and this is without seeing earnings growth or sales growth, then I would be one of the first people to recommend to get out of the equity markets, because these are at crazy valuations. Dividend yields would be extremely low. they would be pathetically low. They would be close to 1% or lesser than 1%, and one should not be investing into equity markets with respect to dividend yield at that time. But if markets were to fall down to say 10,000 levels or less on the Sensex, then I would say that we invest as much amount of money in good companies which are and are shown to be consistent cash flow generators, because the dividend yield would be extremely awesome going forward for the next 5 years. So this is how you should see dividend yield is a more function of when you invest, at what price you invest, as in what quantity you have invested in. The next question is by Ankurya. His question is, what is your call on Tata Steel? Can I buy right now? Ankurya, there are lots of things that are happening in Tata Steel. We are looking into Tata Steel closely. You should see a big revision happening in our DP and our MRP over the next 1 month. And for that reason, I would request you to just wait out. That revision would also be accompanied by a note, and that would clearly state out why we are making a shift now back from being extremely negative over the last 2 years with respect to Tata Steel. Just like L&T, we are not very excited with the Tata Steel given the pathetic level rows that they were running, largely driven by the misadventure of Chorus. But now, if we see things turning around in the Indian side of the business, and if in the stabilization in the European side of business, I think it merits a re-look at Tata Steel as a investment-worthy company. So, we'd like to see it. We'd like to see if there is a good case to build, say, expectation, good expectation to build of ROCE increasing going forward, then Tata Steel would be definitely get re-rated by us on the with a bias towards the upside. The next question is by Mr. Suman Kumar. This question is with respect to he bought ICICI at 99.69. Should I book profit? Mr. Suman Kumar, as a general thesis and as a long-term investor, I'm generally a bit skeptical investing into private banks for a simple reason that most of the private banks are trading at a very high valuation levels, and given the fact that an RBI is not actively looking forward to allow automatic licenses for specific bank operations, I believe the competitive advantage that people have earned because of barriers of entry that banking industry had. So because it was not easy to open a bank without RBI's permission, and RBI itself was very reluctant to in giving those kind of licenses. I think the competitive advantage period of our banks is nearly over. It does not merit us to give any more now, anything above 1.5 times of price to book value. Even 1.5, it should be given only to good companies who show very good return on equity, good CASA and a franchisee, and then a strong low level of NPS. These are the companies in which we should be given 1.5 to 2 levels of price to book value. Otherwise, most of the time, I am now of the opinion that over long term, I think that level of banking industry competitive advantage of the banking industry is now going to get weaker and weaker, and so one should start thinking of whether one should start exiting banks, or one should just ride out to a level till say lots of banks come in. But the way it had happened for telecom, I think same way would happen for banks, that the market economics of the business are going to go down. The kind of competitive advantage they had, they would not continue to enjoy for the next 5 to 6 years. uh, The next question is by Mr. Shirish Shah. His question is, at current price, can we shift from BOB to PNB? See, PNB is already above our DP, marginally above our DP. Our DP is somewhere close to 600, and it is already trading close to 800. If you have comfortable with that kind of 10% downside, yes, I would suggest go from BOB to PNB. Otherwise, much more better strategy would be to move from BOB to Canara Bank. But as a way of the management and the way kind of business asset class that PNB has invested, I would be more positive on PNB than on Canara Bank also. Even though Canara Bank is at much more lower, at a much more attractive valuation level, so one just be open to a 5%, 10% correction in PNB, and you can move from BOB to PNB. That would be a much more better strategy. If you continue to stay in BOB, be open to the fact that that 5 to 10% correction is anyway going to hit you in the BOB also. The next question is by Mr. Mahesh Khedkar. His question is, can I buy Cummins at current market price for long term? We would expect a small correction to take place in Cummins, and then it would be a good time to enter into. As a company, we do like Cummins. It's an extremely good company. However, we would want it to correct at least by say 75 to 80 bucks at least. It would not yet hit my DP, but at least if it corrects to 75 80, we would like to we would really like to support entering into Cummins as such. This would be the last question that I would be taking. What are the prospects of Power Grid? Is it a sell at 117 levels? Um, Companies like Power Grid or NTPC, these are all, or even NHPC, these are similar kind of companies in which the growth that may happen would happen at a very slow level. This is a much more dividend kind of a story that you need to look into rather than thinking of it capital appreciation point of view. I think you can look at when exiting Power Grid as such. One much it, see there is when you look at investing in any company, it's very important to understand the motive of the management, especially with public sector companies. In the case like Power Grid, the motive of the management is not just to earn money, but it also to satisfy a social need of increasing the grid spread out across India. I think that grid spread out may only increase. However, uh, it is will still take time and it will be a very slow process, so one needs to uh, be over there for a much more longer haul and expect if only capital appreciation happening in the range of the 10 to 12.5% CAGR over the next 10 years, and it is much more going to be a dividend story rather than a capital appreciation story. If you are okay with that kind of, you can stay invested in Power Grid, but otherwise I recommend personally recommend that you can exit from company like Power Grid, and if needed even look at company like Power Finance Corporation, or which would have the benefit of similar kind of an economic and case playing out, but has much more better business model. uh, with that, I would like to bring the current webinar to close. It was great to have you. I hope we can now see a bull run. The bull run has been away for next last 5 years. Uh, However, I would like to be cautious. I would like to say that there are lots of risk in the global markets and the Indian economy. We need to see at least subsidization, or we need to see at least the Indian level of risk kind of subsidized to a large extent for to really say that the bull market would really now take place. With that, I would wish you all happy investing. It has been great having you all here today. Hope to meet you next time when we conduct the webinar again on Friday. Thank you very much.